All right, the one big chart that Josh Brown says you need to know about today, it's right on your screen. Tell us why you're focused here.
One of the most exciting things about the U.S. stock market this year so far is that it looks like we're going to finish this quarter with something on the order of 16% earnings growth. Unless NVIDIA is something shocking to the upside or the downside, that seems pretty secure. But in Europe, it's not altogether different. You've got big beats for European companies, specifically European blue chip, very large companies. And I think it's worth pointing out, this index right now is outperforming the S&P. Let's take a look at the FEZ. So that's a proxy for large cap Europe. It's like the Dow Jones of Europe. And please keep in mind, this excludes England, okay? So it's mostly Germany and France and Spain to some extent. FEZ is up 14% year to date, 12% over the last 12 months, so the rally is accelerating. The RSI is at 73, a little bit overbought, but still has room, 9% above the 50-day moving average, 7% above the 200-day, and this is the highest level for the FEZ since 2008, almost 20 years ago. When you look at what stocks are making this up, ASML, we all know, it's involved in lithography for chips, but also SAP. Siemens is doing great. LVMH is a big weighting here. Schneider Electric, Total Energies, Allianz. Some of these companies are highly involved in the financials rally, and some of them are involved in AI and automation and robotics. And if you don't have this in your portfolio, or you've been ignoring it because of S&P outperformance, every once in a while things flip, and you'll be shocked at how well some of these overseas markets can actually do. So take a look at Europe if you haven't yet. Consider possibly adding something to your portfolio.
What do we think?
You know, it's sold off into quarter four. We've rotated out of Europe. We have in our ETF portfolio that couples with an 80-20. We went to equal weight S&P and IJR after the market had rallied about late January. I think there's some tailwinds here. A lot of negativity coming into the year, so it's definitely, as Josh pointed out, probably very underpositioned, and that's where the flows begin to pick up, and that's where you have a move like this.
They had an AI festival in Paris last week, and the country, France, said that they're going to put $109 billion into AI investments, which by European standards, it's not Alphabet, but it's like adorable, low key.
You're basically playing for the bottom. I mean, that you've seen the bottom in Europe.
We had a 20-year stretch where the differential in performance between European large cap stocks versus the S&P 500 historically stretched. Like, we have never seen a differential. So it's not to say like these stocks deserve a 21 multiple like the S&P, but they're cheap. You don't have to pay that sort of multiple. And if they get some things right in tech and they relax on all of the regulations and they decide they want to be a player in AI rather than the referee, you never know. There could be some big winners here.
We'll say there's a currency thing here, too. It's the dollar topping. If the dollar ends up topping, which I do believe, you're going to get some tailwinds in the euro, and that's going to be really good for
point you make, too. What about this, Liz?
Look, I mean, unpopular opinion is that international outperforms the U.S. this year. I think it's quite possible Europe might be a part of that. However, that's probably not the first place that I'm looking for buying opportunities.
China beat the S&P last year. Almost nobody you talk to knows that.
Exactly.
So these things have a habit of sneaking up on people.